Are you aware of the bullish and bearish trends on the Forex market? Do you know how to identify them and how to trade effectively in both types of markets? Trading Forex is like being in a zoo. You're either riding a bull or you're wrestling a bear. Hello friends, in today's video, we will learn the concepts of bullish and bearish markets, providing insights on how to recognize them and trade effectively in each scenario. Before we start, please hit that subscribe button and the notification bell so you won't miss any of our lessons. All right, let's get started. Bulls and bears have their own language in the Forex market, and it's called chart aperture. What? You took this seriously? That was a joke. It is not called that. Now let's seriously get started. First, let's get into the bullish market. What is it and how can you spot it in Forex trading? A bullish market, also known as an uptrend, is a time when prices are on the rise or are expected to increase. Think of it as the feel-good phase in the market. In a bullish market, price charts show a consistent pattern of forming higher highs and higher lows, which is a strong indicator of an upward trend. Now, what fuels a bullish market? Several factors can contribute to it, and it's important to be aware of these. The factors include robust economic growth, positive news, low interest rates, high demand, or a limited supply of a particular currency or asset. So why did the Forex trader bring a trampoline to the bullish market? Because they knew it was all about bouncing into those profits. Next up, let's dive into bearish markets. What are they and how do you recognize them in Forex trading? A bearish market, or a downtrend, is the opposite of bullish market. It's when prices are falling or expected to decline. Think of it as the rainy day phase in the market. In a bearish market, price charts typically show a pattern of lower highs and lower lows, indicating a clear downward trend. Now, what triggers a bearish market? Let's look at the factors that can lead to this type of market condition. Bearish markets may result from sluggish economic growth, negative news impacting a currency or asset, high interest rates, low demand, or an oversupply of a specific currency or asset. And when the market goes bearish, some traders go very quiet. Let's start with the bear. Think of a bear in the wild. When it attacks, it swipes its paw downwards, right? Well, this is a lot like a bearish market where prices are dropping. Just as the bear's paw goes down, prices do the same in a bearish market. Now, on to the bull. When a bull charges, it thrusts its horns upward, which is pretty much what a bullish market is all about. In a bullish market, prices are going up, just like a bull's horns. So it's all about these animal symbols matching their attack styles with market trends, a bear for falling prices and a bull for rising prices. Let's get right into it. How do you recognize whether a market is bullish or bearish? We'll explore two common methods to identify these market conditions. Before that, here's a question for you. Why don't the traders ever invite the bear to their parties? Come on, think. Do you have an answer? Well, because he always brings the market down and they're all about keeping things bullish. First up, trend lines, the road signs of trading. They're simple yet powerful for determining market trends. Trend lines connect two or more points on a price chart and give you a clear view of the market's direction and strength. When prices are on the rise, these lines connect the lowest points, also known as support. In a downtrend, they link the highest points called resistance. Now, another way to identify market conditions involves using technical indicators. These mathematical tools use price and volume data to give us trading signals. Some of the most common technical indicators include moving averages, oscillators, and momentum indicators. Let's start with moving averages. Think of moving averages as a way to smooth out the bumps in price data. They show the average price over a specific time period. When the price is above a rising moving average, it's a sign of a bullish trend. On the other hand, if the price is below a descending moving average, it indicates a bearish trend. Moving averages are excellent for helping traders understand the trend's direction and strength and for finding entry and exit points. Next, we have oscillators, the heartbeat monitors of trading. These indicators measure the speed and intensity of price changes. Oscillators help you spot overbought and oversold market conditions and predict potential reversals. If an oscillator shoots up to a high point and then starts to drop, it suggests an overbought market that might turn bearish. If it falls to a low value and then rises, it's an oversold market with potential for a bullish reversal. Finally, let's talk about momentum indicators. These gauge the energy and speed of price movements. Momentum indicators help you figure out if a trend is likely to continue or if it's about to change. If the indicator is rising along with the price, it's a sign of a strong and ongoing trend. But if the price is rising while the momentum indicator is falling, it's a sign that the trend is losing strength and might reverse. Technical indicators are like the seasoning in your Forex trading recipe. Use them wisely, or your trades might end up overseasoned. Cut now, let's discuss what are bullish and bearish candlesticks. A candlestick chart is a visual tool used to represent the price movement of a trading instrument, such as a stock, currency pair, or commodity over a specific time frame, like an hour, a day, or a week. It provides information about the opening, closing, highest, and lowest prices within that time period. When you look at a candlestick chart, you'll notice two main types of candlesticks: bullish and bearish. Bullish candlestick appears with a green or white body, indicating that the closing price of the trading instrument is higher than the opening price. This suggests that buyers have dominated the market during that time, driving prices upward. It signifies a positive sentiment and potential for price increases. Now let's move to bearish candlestick. On the other hand, a bearish candlestick is characterized by a red or black body, symbolizing that the closing price is lower than the opening price. This signals that sellers have been in control during that period, causing prices to decrease. It reflects a negative sentiment and the potential for a further decline in price. The size and shape of the candlestick body and wicks provide important insights into the market trend. Bullish momentum. A long bullish candlestick with little or no upper wick indicates strong upward price momentum. It suggests that buyers are in control and the price has significantly increased during the given time frame. Bearish momentum. Conversely, a long bearish candlestick with a minimal or no wick indicates substantial downward price momentum. This means that sellers are dominating the market and the price has decreased significantly. So you have learned what are bullish and bearish candlestick. Now answer this question. What did the bearish candlestick say to the bullish candlestick? You need to lighten up. Don't be so wicked all the time. Now let's learn how to trade in bullish and bearish markets. Forex trading is all about making profits in both rising and falling markets, and it all begins with understanding currency pairs. In a bullish market where prices are on the rise, traders follow a specific strategy. They go long on the base currency and short on the quote currency. Let's see this in action. For instance, if the Euro-USD pair is on the way up, traders seize the opportunity to buy euros and sell US dollars, positioning themselves to profit from the ascending price. But what about bearish markets when prices are falling? Traders switch gears and opt to sell the base currency and buy the quote currency. Let's take a look. In a bearish market like the US dollar, Japanese yen on a downtrend, traders sell off their US holdings and acquire Japanese yen, aiming to profit from the declining US dollar value. To succeed in Forex trading, it's vital to have a solid trading plan. Here are the key elements you need to include. First, you need a clear trading strategy. This outlines when to enter and exit trades, which can be based on either technical analysis using charts and indicators or fundamental analysis considering economic events and news. Second, a risk management system is crucial. It sets limits on the risk per trade and guides you on setting stop loss and take profit levels, ensuring responsible risk control. Lastly, don't underestimate the power of trading psychology. It's all about managing emotions like fear, greed, hope, and regret. These emotions can significantly impact your decision-making in trading. Before wrapping up, here's a question for you. Why did the trader always carry a backpack in the bullish market? Because he wanted to be long on the go. So that's all for today. While the potential for rewards in both bullish and bearish markets is enticing, trading in these conditions can also be intricate and challenging. You need to stay vigilant to market shifts, stick to your trading strategies, and remain adaptable in the ever-changing financial landscape. If you liked this video, please hit the like button and subscribe to our YouTube channel.